Ladies and gentlemen, good day and welcome to Q3 FY23 earnings conference call of Data Patterns India Limited, hosted by Go India Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Monali Jain from Go India Advisors. Thank you, and over to you.
Thank you, Yashashree. Good afternoon, everyone, and welcome to Data Patterns India Limited earnings call to discuss the Q3 and 9-month FY23 results. We have on the call Mr. S. Rangarajan, Chairman and Managing Director, Ms. Rekha Murthy Rangarajan, Whole-Time Director, and Mr. Venkat Subramanian, Chief Financial Officer. We must remind you that the discussion on today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risk that company faces. May I now request Mr. Rangarajan to take us through the company's business outlook and financial highlights, subsequent to which we will open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Monali. Good afternoon, ladies and gentlemen, and thank you for joining us today for the Q3 FY23 results call. I believe you must have seen the results presentation which is published on the exchanges and our website. While Venkat will walk you through the results, I would like to briefly touch upon some of the strategic updates and key highlights of this quarter. We have delivered the highest ever Q3 and 9-month revenue and profitability. We are currently doing better than our guidance to the market, though this is as per our internal projections. We kicked off 2023 with yet another significant order from DRDO, demonstrating our continued leadership in the domestic radar and EW areas with products that meet international standards. Considering our healthy order book, we have considerable insight into our upcoming performance. Our order book is robust at 1,014 crores, underlying both our diversity and showing our homegrown expertise in cutting-edge defense technologies. I'm pleased to inform you that we had a strong order intake of 163 crores, up by 3.3 times in Q3 FY23. We have a very strong sense of revenue visibility because a sizable percentage of this comes from development contracts, which will eventually transition into production contracts. Some of the large orders we received in Q3 FY23 are: 1. We received a radar order from DRDO and BL worth 7 crores. These are for development and production orders. 2. Development orders worth 24 crores for electronic warfare from DRDO. 3. We received a production order from HAL and the Airport Authority of India, totaling 75 crores in avionics and airport management. 4. Another production order worth 57 crores is received from BrahMos and other programs. With the country moving towards Atmanirbharta in defense R&D, this sector has been taking massive strides in order to upgrade and modernize its capabilities. Drawing lessons from the recent global political crisis, the Ministry of Defense has launched various acquisition initiatives and RFQs, and we are ideally positioned to gain from this sectoral opportunity. With a new manufacturing facility expected to commence from Q4 FY23, our capability in R&D, engineering and execution will get a much needed boost. We have successfully completed site acceptance test of 2 precision approach radars. We have also been nominated as development and production partner for Dornier upgrades. Since we have the best-in-class manufacturing facilities and a strong debt-free balance sheet and good working capital lines, we are in excellent position to showcase our indigenous capabilities in cutting-edge defense technologies. Our strategic priorities for 2 years are clearly defined, which are as follows. 1. We will concentrate on greater opportunities in radar, electronic warfare, and satellite markets. 2. We are expecting to participate in over 20 to 30 billion worth of contracts for the next 3-4 years. With these efforts, we should be able to achieve a top-line increase of 25 to 30% and sustainable high margins in the range of 40%. As you are aware, we have obtained the board's approval through an enabling resolution to raise a fund up to Rs 500 crores. This sector is seeing strong growth in government, and the government is pushing for Make in India. We want to be prepared for this growth opportunity both in terms of manufacturing facilities and product development. I will now hand over to Venkat for his comments.
Thank you, sir, and good evening, ladies and gentlemen. We are pleased to let you know that we have delivered the strongest 9-month performance ever. I would like to walk you over the quarter's financial results, which include our revenues increased by 2.5 times in Q3 and 2 times in year-on-year 9 months to 111.8 crore and 268.3 crore in Q3 FY23 and 9 months ended FY23 respectively. Development contracts generated 28% of Q3 revenues as compared to 13% Q3 in last year. The contribution from production contracts were 65% in Q3 current year as compared to Q3 last year, 67%. Lastly, service contracts contributed around 7% in Q3 of this year. The gross margins for Q3 and 9 months were maintained at 66 and 65% respectively. PAT for the quarter increased by 4 times to 33 crore, and for the 9 months it increased by 2 times to 69 crores, led by a strong EBITDA during the period. We have invested around 36 crore in the new facility till date, and we expect the new facility to be operational in Q4 of FY23. We have a net debt-free and robust balance sheet with a cash on hand of 61 crore at the end of 9 months, and are striving to maintain the working capital cycle around 300 days. The overall 9 months performance was pretty impressive, producing record revenues. Although Q4 is still an important quarter, we can observe that the seasonality is gradually decreasing. We will now open the floor for question answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Renu Baid from IIFL Securities. Please go ahead.
Yeah, hi, good evening, team, and congratulations for very strong performance both on inflows as well as execution and earnings. My first question is to understand a bit more while YTD we have already achieved almost 680 crores of inflows. How are we looking at the order inflow for the rest of the year, and specifically for FY24, especially that large projects like Himshakti, etc. were delayed from fiscal 23 to 24. So if you can share some update on large orders in pipeline and outlook on the same.
Okay. We expect about 150 to 200 crores this current quarter. Additional orders are expected. Today also we negotiated a contract which we'll be announcing. So as regards next year, as you rightly said, the programs like Himshakti, Arudra, all of them are almost in the stage of finalization. This is what we hear from the market. And once finalized, I think back-to-back some contracts are expected with us, by us. So this is 1 or 2 big orders which will come, which will be a single tender for us, which will execute. The second portion is, like he announced, we have also become a development and production partner for 2 programs of Dornier upgrade. So that one letter of intent has already come. One more today we finalized for EW. This is for radars and EW for a Dornier upgrade for Navy. This is a development contract which is initiated by DRDO. Hopefully once we deliver this product to DRDO and it's operationalized by them, we expect that back-to-back orders for the upgradation of Dornier aircrafts by HAL, the orders should also follow in the coming years. So that is an important development. And the other things is we are also participating in MOD fast-track tenders, some, and also the Make 1, Make 2 tenders. We are also expecting the tender to be released in the next few months for the Ashwini radars, where we are also participating. I think the AON has been cleared, so we expect some contract, inquiries to happen. and we need to bid against competition to see where we stand, but there is some idea that we should get some contracts in that. So these are essentially some of the top of the line order which are getting into my head, but there are a lot more areas we're working on to see that we increase our order size.
Got it. Also, you mentioned that, from a longer term perspective, you think this 25-30% revenue growth is sustainable with high margins of 40%. So as we win larger projects in EW, radars, including system integration, you have reasonable amount of optimism of sustaining 40% plus EBITDA margins, or you think margins could moderate a bit as growth accelerates at 30-35% plus CAGR?
This obviously depends on the contract and the competitive contracts we've got. So some of them which have been delivered early, and it's a mix of contracts, so the EBITDA margin comes up. And at the present moment, we think that we should be able to retain the EBITDA at 40%. And as we scale larger, we have to look at the kind of contracts and the mix of contracts before we can give guidance. So I think we should, at the present moment, we would like to stick with whatever guidance we've given you.
Done. Secondly, sir, we have taken an enabling resolution for nearly 5 billion rupees worth of equity or debt or both combination. So, what kind of growth capital you think you'll be needing in the next 2 to 3 years, A, for the current organic growth, and B, if you win certain large make one, make two programs with some foreign OEM partner?
Okay. We have taken an enabling resolution for about 500 crores from the board. The board has been very supportive. We have to look at the business very differently. We can't be reactive to this market. We have to be proactive with this market. As you know, we have been a product development company with in-house IP generation all through our history of the company. And while earlier days, we could only look at a cash flow kind of management style, where every available penny we put in product development and slowly grow the business. This is what the model followed all along. But that model today, though we have done this, invested a lot in the last few years or so many years, and the orders have started coming in now after a few years of gap. But the market itself has changed. It's gone through drastic changes now. To follow an earlier model that we will generate, develop products slowly and then push it to market will not give us the accelerated pace which we need today. Not just what we need to grow, but also what the market opportunities are. The market opportunities are enormous today. And this is, like I've been always saying in the last calls with you, is that, we are trying to actually tie with foreigners in India and build some percentage in India, work share, and address the market space. We've always been saying that is not the way to address this market. We have to build products here in India and get a better probability to win based on IP generated here, because then the cost model becomes much lower for us than a competing company who imports and integrates. So we need to actually build an ecosystem, build the Indian defense equipment, which is world class. We've always been, talking about that. And the market opportunities today, there's been a flurry of RFPs coming in the last 3 months. So we need to address those opportunities with actual products. If we do it the way we've been doing all along, we may miss the opportunity, miss the bus. So we've talked to our board, and board has sanctioned this, that yes, we need to aggressively position ourselves, scale the business substantively. See, what we are really raising funds for is not to do what is coming year or next year or 2 years. We are looking at a 3, 5 year, 10-year market and says, if I have addressable products available to increase my total addressable market space. So that is the idea with which we're doing, to gain traction, build products, have the prototype products assembled for trials on your make one, make two, or buy Indian, IDDM, all kinds of categories that the MOD comes up with, and then address the market to see that we get that rapid growth which is essential. The market is growing. It is up to us to be there and be counted or fall behind. We don't want to fall behind. So that is the idea of aggressively trying to bid and grow. We're building capability for tomorrow. That is the kind of market we are looking at. And we want to be stand and count. So this is one. So the money raised is for that. We also would put something in working capital. We'll also put some capital, CapEx, put some test infrastructure, all towards building an organization to scale rapidly in the next 3 to 5 years, we need to address the market with products and competencies. So that is the idea of doing this.
That's pretty much helpful, sir. Just to follow up on this, would you have any names or segments where you are tying up with foreign partners to share with? You may not win, just about participating in the market with foreign OEMs in certain categories to share?
See, it is not necessarily, one Make 1 and Make 2 is a design in India configuration where largely you design in India, not with foreign partners. So that is one. So we really don't have to have a foreign partner to quote in Make 1 and Make 2. We're trying to do it alone wherever possible. Even if we have to go with foreign partners, it's not appropriate to name them at the right moment. We would like to do this. It is contract dependent. We have a few people we're working with, and where we are trying to have a deep relationship, not a contract specific relationship, trying to have a more deeper relationship where not only we co-build products which make sense. So that is what we're trying to do. So I would like to name the companies, but largely we are trying to build on our own. The second thing I can tell you is very selective about where we want to build products. We don't want to take money and then do a hit or miss kind of category. They're already ahead of the rest of the market in India in certain segments like radars and electronic warfare and satellites. We want to reinforce our capability here, build products in that, be world class, and make the Indian market, and later export these products outside India. So we want to be specific in certain domains. We're far ahead. We've already built building blocks in this. Try and build more building blocks in this so they're ready to address the market during trials, be ahead of others, create IP here, so the value creation is far, far higher. That's what we'd like to do. That is where we're going to the market to get money.
Perfect. Very helpful, sir. Thanks much and all the best.
Thank you, Renu.
Thank you. Thank you. We have our next question from the line of Sandeep Tulsian from JM Financial. Please go ahead.
The first question is pertaining to some of these orders that you mentioned, the Dornier upgrades, the two versions, one is for Navy and other is for Air Force, and also the precision approach radars where we are expecting some orders. Is it possible to give us some estimate of the size of these orders and the tentative timeline?
We received an order for Dornier upgrade for development contracts for the airborne radars, and also we expect a contract come for the ESN, that is the EW upgrade portion of the Dornier. This is one is already letter of interest come, the other one negotiations are on. And these are for development purposes to see that we prove it on with DRDO on HAL's aircrafts, or naval aircrafts. Subsequent to that, depending on how many units Navy wants, maybe it's 10 systems or 25 systems or a number of aircrafts, back to back, once it's successful, the contract should come. They are in a hurry to fly it and test it. So we expect that maybe the backup order should also come in the next 2 to 3 years. As far as PAR is concerned, we are going as per contract. We have delivered, accepted, 3 systems have been already accepted. The 4th one is acceptance is over in our premise. It is under integration at customer premises. The other ones, as per contract, we are executing as per contract. All of them, one more system will go in the next 1 month or so, and maybe we'll be ahead of delivery next year, what is necessary. So, what is on track? Since the radars are working well, there is also some interest to see whether follow-on orders can additional orders be placed. But that is all under discussion. At the present moment, I don't have clear idea, but I think maybe there is a possibility of additional orders also happening. But I can't tell you exactly how many and where at the present moment.
Understood. Fair enough. Secondly, sir, in the previous calls, you have also given some status updates on the new products or new areas of RF seekers, where you were one of the qualified parties along with ECIL, and also on the satellite development that we were undertaking. Will there be a big capital commitment towards that? Where are we in that development cycle? If you can update on these 2 areas, please.
The RF seekers, 1.5 months back, there were actual trials. This is what is called as capital trials on Sukhoi 30, which happened, which is successful. We are awaiting additional trials either on capital or, again, I don't know whether I'm supposed to talk all this, but you asked the question, I have answered. So, So we have to wait and watch what DRDO does, but we are in line with their thinking and the products are functioning as of now. So we need to await DRDO's instructions for next trials to see where it goes. Product itself is performing. As far as satellite is concerned, it has been a long Data Patterns has been invested into complete satellite development for the last decade. We went on the student satellite program where we decided we want to get our satellite to space where design is done in-house completely. So we did a satellite long back. We started in 2014 design. Only decision was we'll never import anything. We'll build all the satellite here in India, all the capabilities, including the ground station, the telecom, all the everything which communications, everything we'll design in India. And we want to design it as a military satellite. So all the capability of military satellite we want to put inside. For example, complete redundancy on the satellite. So no single point failure. Everything about the satellite, the health of the satellite, every current voltage is monitored and telemetered down to ground station. So we can then see which part of the satellite is not functioning, in which case we can switch it from ground and make that satellite operational. Whatever ISRO has or the capabilities, we said we'll duplicate it in a small satellite program and make that scalable so that once you get some experience on air, on the satellite performance and validation, all the algorithms are validated, reliability established, we can scale it for defense satellite for India as well as outside India. We largely achieved it. We had another satellite for Pixel launched about a month or back. The satellite is fully functional. We handed over the satellite to Pixel. All functions are done. ISRO has taken all the satellite parts of ours for their own nanosatellite program. They even taken our ground stations from us to do this. So they also have confidence that our system is working. The Bhutan sat which is uses most of the onboard systems are all ours, which is done by ISRO, used by ISRO. So they also have confidence that systems are working. So we have some operational experience, an in-flight experience, and space experience on our products working for a few years, and a competency on building entire systems. So obviously we thought, this is one of the areas where core competence is established over the last 10 years. We need to actually build a proper satellite for defense and space. So that is one of the strategic program moves. I have been talking about it off and on. Now that the second satellite is fully functional and working, we are also building a small satellite with the MWIR sensor camera that is also designed in-house. That's also hopefully should be launched in the next few months. So we are building a competency model here, fully grown in-house competency model. So we're going to do this. We're going to invest further on this to see that we can address, like I said, the market today. Last year when I talked about the market was not visible. It was all handled only by ISRO. But today the market is getting exposed to industry here. Already Make 1, Make 2 programs are coming up with memory tenders. ISRO is also looking at building, satellites using private sector for such applications. So there is a lot of talk now, and so we want to be ahead of the game and build and see whether we can do world-class systems with Indian competency. So we are going to start investing in this opportunities and create our own opportunities in this space.
Understood. And so last question from my side is on the net working capital cycle. Where did we end? Where was the working capital position at the end of third quarter? And if you could also give the absolute rupees crore amount for debtors and inventory at the end of 9 months.
Venkat, you can answer that.
Sandeep, our net working capital days remained almost at the same level throughout this year so far, around 350, 360 days. We expect it to gradually come down. That's what we have been telling in all the calls. We expect it to be gradually coming down to probably around 280 to 300 days. But currently it is high because of inventory holding due to advanced procurement, which we plan and procure ahead of the requirements, considering the non-availability of material due to COVID situations. Though the material availability is reasonably eased out now, but we have already procured, and that is the reason for the net working capital higher in the year so far. We expect it to remain almost at the same level in March as well, but going forward it will gradually come down.
Understood. Understood. Thank you so much sir, for taking all the questions.
Thanks.
Thank you. A reminder to participants to press star and 1 to ask a question. We have a next question from the line of Harshit Kapadia from Elara Capital. Please go ahead.
Thanks for the opportunity and congratulations for a good set of numbers, sir, and good order inflow. Just a couple of questions. Can you just update us on the BrahMos status, where we were trying to do some testing for RF seekers? Any update on that? And there are other companies who are also bidding for it. So what's the status there?
That's what I said in the last question with Sandeep. The seekers have gone through some capital trials on Su-30. We finished that capital trials about a couple of months back. In the month of December, the trials were there. We're awaiting additional trials from DRDO. The products are working well, and it has now left to DRDO to take additional trials and then certify it. So once they do a missile trial and certify it, then it will be ready for production. So we expect in the next few months that should happen. I am not privy to exactly when the trials are going to happen. They will let us know as it's happening. But we are on track. The products are working. So at the present moment, that's all I can say as far as BrahMos is concerned.
Fair enough. So is that a possibility then in FY24 we may get a few orders or maybe on production basis for this?
I don't know. See, it should come in natural course if they take a decision to put our seekers or Indian seekers into those missiles. So today we're importing them. So it would make sense to do more in India. Now this is a decision between BrahMos and DRDO. Of course, they can't do this until the missile tests are done. I don't know when they're doing. They're saying it is going to be done in a hurry. So we don't have the dates as of now. But our people are working with them. So as and when it's done, and I don't know one test or two tests, what they would like to do. So, but it should naturally happen as long as the product performs, is what I would think, because we are also less than 50% the import price, and there is a lot of pressure now to do more in India and reduce foreign exchange outflow. So naturally it should happen, but dates I'm not able to tell you about it. It's not really, at the present moment I don't have data with me. I'm not, they're not projecting that for next year turnover. See, we want to be very clear when we project turnover, we want to be very clear that these contracts will happen. We don't have control over this. You only give the product, working product. That is all we can commit at the present moment.
Fair enough, sir. Another question is, as you become, as your new facility gets operational and you try to become a system integrator, what are the key projects that you will be bidding for, if you can highlight some of them?
See, the areas we will bid will be similar to where competencies have been built. See, over a period of time, we have tried to build complete competency in radars. So we will try to now bid against Make 1, Make 2, IDDM, all these kind of contracts comes up. Wherever we believe we have a competency model, we will try to build those systems here. And then for that, we have the new facility which we have created can bring in about 10 trucks can come inside. We can build radars on trucks. We can build big radars. We have put foundation for all of them. We have put clean room and doubled our production capacity in terms of, we put a second pick and place line. We added more vibration tables. So we are doing what is necessary. We are going to put in a full EMMC infrastructure, a full 461, which is now going out and waiting in line for testing. All that we are now creating our own infrastructure. So timelines for delivery, timelines for tests is shortened, and delivery mechanisms are enabled. So what is necessary is debottlenecking. We have done that. So test equipment we are putting inside. As far as the programs are concerned, where we will build our prototypes and demo units and FPT trials, this will be in the areas where we have already built a competency, and we build a lot of building blocks to enable us to create a system without going through complete development. It will be more re-engineering and partial development, reuse of already developed technologies. And even in those things, we are going to address markets. We will try to do subsystems which is reusable, so that the risk of getting one contract should not write off the development. So we will position it against many contracts. We will be very, very prudent on what we spend. We've always been prudent on money spending. We're very tight on money. We don't spend money easily. So we will be very, very careful on how we spend the money and see that we differentiate ourselves from the rest of the market. We want to be the equipment suppliers in India, not try and import and integrate. So that is the line which we want to take, differentiate and grow. But since the growth is going to be, the market access is so big today, I need to take some large kind of investment model to see that we expect the market is addressed properly. Otherwise, we lose the business, meaning we will not scale as fast as we want to scale. The opportunity is provided. We want to invest in this. So new facility is going to help us address these opportunities, and also we are creating more bandwidth to see that we create products for the new opportunity which is pouring in.
And you believe that with this new facility, you will be very competitive in terms of bidding, and you can get very strong.
No. It's a bidding. It's not going to be a new facility. Will not allow me to be competitive to bid. The new facility will allow me to build the product, validate it in house. Because see what happens is the facility is for two reasons. One, for increasing our product manufacturing scale. With new orders coming in, our capacity building has to happen. So that is one for the new facility which helps us meet the capacity requirements. Point number two, when you move from subsystems to systems, when at the present infrastructure, I can't bring my trucks inside and outfit a truck for a EW or a radar application. Okay, so these we could not do, and so we created an infrastructure where a large, multi-ton metal can be moved inside. They can move facilities inside, integrate the system. It will be with us for 6-9 months before you build a product, then take it for and qualify them, then take it to trials with the MOD vendors. It will allow us to do all this in-house. It is very difficult to say I'll build a substation. I don't have infrastructure. I can go outside and build. It may not be it may not be practical to do all this. So while doing this new factory, we have created areas where we will graduate from subsystem or a box supplier to a weapons or a full system supplier, for which we need to transition ourselves in terms of infrastructure. We have created the necessary infrastructure to do this. It will not that with that I can do 5,000 crore. No, what will happen is initially we will see that address opportunities in MOD. If we get a contract for 2,000-3,000 crores, additional infrastructure will be built as a production line assembly. But with the existing infrastructure, we can participate in major programs, build our own systems and to scale products, demonstrate the system, and be competitive. That is the facility what we're creating. The capability comes from in-house manpower rather than infrastructure alone. The infrastructure helps, but it is all IP created over many years and continue to create and invest on people. That is what we do, maximize our manpower content.
Fair enough, sir. Thanks for that answer, and I'm wishing you all the best.
Thank you.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Akshay Kothari from Envision Capital. Please go ahead.
Yeah, thanks for the opportunity. So just wanted to know, why did our employee cost reduce despite headcount increasing?
No, it's not reduced.
It is not reduced.
Quarterly basis it has.
No, it is not reduced. Actually, it is increased only.
From 19.14 crores, it has come down to 18.
That is because of some, actuarial valuation and related provisioning. Actually, it is due to actuarial provisioning. Some small reduction is there. That has nothing to do with actual salary. It is only the actuarial valuation because of some, leave encashment provisioning and things like that, which has caused a small change in the numbers.
Okay. My second question is on related to Pixel.
Sir, you are sounding very low. Can you
Yeah.
use your handset, please?
Am I audible now?
Yeah.
Yeah. So my second question is related to Pixel. So they have received funding from one of their PE partners, and they are developing around 24 satellites. So I have two questions regarding it. One is, we had developed a nano satellite for Pixel. So what was the amount for that, quantum of that nano satellite?
No, we invested also in that. We wanted to continue development. It is not selling price, but we have a contract about a couple of crores or so. I don't know exact amount. It was done about 2-3 years back. Slightly more than a couple of crores is what we got in order when we executed it. And that is more towards because they're a startup, and we said we will also invest with you in making that happen. That is how the whole thing happened.
Okay. And regarding your earlier comments, so what exactly are we doing for Pixel right now, and what is the revenue potential for that?
What is that? Yeah, can you repeat the question?
What is the revenue potential we can expect? Because they are developing some serious satellites. They are developing around 24.
Revenue potential. They wanted to they have raised money to build their own satellites with people like us, and then probably sell images to customers. So that is a business model they told me. I really don't know what they're doing today. But this is all one-off contracts. We don't know whether multiple contracts will happen tomorrow. I have no idea. But we looked at it not from a contract point of view. We looked at a point of view of building capability to see that we prove our capability in terms of products and space and get space lineage. And because this is an incremental capability development program, we can't do this overnight. As failure, then we need to find out mistakes, correct it. So that is the endeavor for me to do this. And now what is that? We have a competency model. We want to build products which is serious defense applications and civil applications. Today we are confident because of the successes, we know we can do this more. So that is where we're going. The direction is going to be much more clearer in what we want to do in big satellites.
Okay. And lastly, regarding the enabling resolution of 500 crores, so you have mentioned that it could be debt, equity, or a combination of both. So what exactly would be the key drivers for determining which mode of funding would be used? Would it be like if the project is risky, we would be going for equity funding or something sort of that?
You see, what happens is why we said some working capital debt and all that may happen to keep with their turnover increases we may do. But as far as this is concerned, we need to look at appropriate funding for appropriate programs, like you very clearly said. So we need to take a calibrated view depending on the expenditure pattern. Again, enabling resolution has come from my board, and we will take it back to the board on investment model. We have to get their clearances to implement and do that. So that we have to do.
Currently, it is 50-20. It is only equity, right?
As of now, it's 500 crores is only equity, right? It's not nothing to do with debt.
Okay, so I probably read it somewhere. Okay, no problem. That's it from my side. Thanks and all the best.
Thank you.
Thank you.
Thank you. We have our next question of Mihir Manohar from Carnelian Asset Management. Please go ahead.
Hi, thanks for giving the opportunity and congratulations on a good set of numbers. Very good execution and even on the margins front. Just wanted to understand about this enabling resolution which is there. 500 crores kind of a number. What is the rationale of arriving at this number? What will be the capex, working capital investments and the development expenditure that we are going to have, and which are the programs which is going to be the focus for this 500 crores? So if you could split across this number, what is the rationale of arriving at this particular number? That will be helpful. And how are we looking to spend this particular amount in the coming time? And how could it be adding to our revenue? And just some color around that.
I need a bit of time to answer all those questions. We've taken an enabling number from the board now, and we will have to discuss with the bankers and the lawyers to see what we need to do. Also, our statutory auditors, we'll go through this cycle with them and then see what we can do with this and how do we want to do this. In terms of, we'll have to clearly define our infrastructure requirements, capex and test requirements as we go along, and also some will go into general corporate expenses, etc. So we need to do that. Like I said, we've not done it yesterday. Only day yesterday we got this clearance. So we need to, in the next few weeks, we'll try and do this properly. And the other part of the question is where we want to, which are the areas of expertise or product development we'll do. Again, like I said, it will be in areas where we have differentiated capabilities and a large investment already done in product development and subsystems and systems and domain. And we will try to strive and build bigger products in those areas because the market now has opened up for MOD for a number of such programs and products. So there is a common vein on which we can do product development and use that to address market space for the trials which is necessary. This is a mandatory requirement to pass technical evaluation. We need to have demo products to pass evaluation. What people do typically is import the demo products and then try and do this. We want to be different from others in the sense it has to be homegrown. That is when the IP is here. That is when value addition is more. And if you do this, our costs become lower, and hence I'm able to be more competitively priced in the open market here. So with all this in mind, and taking a very long-term strategic view, we will be building strategic products to address market space, which is very differentiated from what other people are doing. So that will be areas, like I said, it will be in radars, it will be in EW, it will be in radios and communication, it will be in satellites, it will be some avionics. So where we are thinking that the contracts can happen and there is a possibility to differentiate and sell, then we're going to put this money there and see that we build these building blocks and the prototypes, the demo units, so that we can address the market requirement with a very high confidence of winning. And also to ensure that we build this as generic as possible, so I can reuse the investment across many programs and products.
Sure, yeah, that's helpful. And this number is largely just from the equity side, right?
It's all equity.
All equity. Yes, sir. Yes, sir. Thank you for taking the question.
Thank you.
Thank you. We have our next question from the line of Kaushal Kedia from Walford Capital. Please go ahead.
Hello. Yeah, hi. Are these margins sustainable?
If you do more in India, the margins will be sustainable. If you buy and integrate, margins won't be sustainable. So our way of looking is try and build more in India. Okay. So our material cost becomes lower. We are not buying and integrating. But when you go to large systems, sometimes what happens, is you need to buy and integrate because we don't make trucks. So when this kind of integrated solution comes, naturally what happens, the margins become different. But largely we are focusing today on electronic systems, which is designed and developed by us. So the margins therefore are higher. But going forward, if this becomes integrated, it depends on the project really. If we compete and there is a project requirement, then we need to buy and integrate from others. Obviously, the margins on a contract value comes down, though the margins on my own systems will be equivalent to what we talked about today. But then we have to look at if the market requires integrated solution, not small boxes, and that is where I have to scale. And there is no ecosystem in India where I build a small boxes to a larger company who does this. So we need to access markets and build the systems ourselves rather than try to import and integrate. So overall, I think if we scale business largely, bottom line will keep going. Sometimes in some programs, the exact margin may not be the same what we do, but bottom line will still substantially grow. And the market size growth will compensate for all of that, is what our belief is.
No, so the current order book that you have of around 800 crores, this order book, how much of it will you import and integrate, and how much of it will you?
All made in India, but some of the contracts we've taken in radars also includes building, also includes bought-outs like generators, UPS. Some of these things are there because it's an integrated product. Some we have to buy and integrate. So in those contracts, the margins may be lesser on a sale value wise, but most of the contracts, other than that kind of contracts, is all designed by us, where the margins are retained. So it's a mix of this and that, but there is what we're doing today in terms of only electronics. We expect to sustain margins. We have to see how it goes along. We believe the sustained margins, the main thing is to try and design more in India, which is why our future strategic growth, we are trying to say retain margins and grow. That's why we are looking, the path that we are taking is very different from others.
No, so
margin here we mean the gross margin, and the EBITDA margin will remain at the guided level of around 40%.
Again, it all depends on the ratio of programs we do. But I think largely this year we will do that. Next year we should do that. We have to see how it goes further.
But EBITDA margin is you're comfortable 40%. You're sure you can say with comfort.
I believe so, unless the ASCII changes and the product mix changes, we should be able to do it. What I believe.
40. And this 880 crores of order book that you have currently, by when what is the timeline for the execution of this?
Mostly 95% of it should be executed in the next 2 years.
95%.
Of equipment is there, which is going into 3 years and 4 years, but the value proposition is less than 10% of the total contract value.
Okay. Thank you.
Thank you.
Thank you. We have our next question from the line of CA Garvit Goel from Invest Research. Please go ahead.
Hello. Good evening, sir. Am I audible?
It is not loud, sir. Please use the handset.
Good evening, sir. Am I audible? Audible now?
So it is not loud, sir.
1 minute. Hello. Now is it okay?
Yeah.
Yes, please
Okay.
go ahead.
Good evening, sir. Congratulations for a good set of numbers. Most of my questions have been answered. Just one more question from quarter four side, basically. So quarter four financial year 23. Historically, sir, your quarter four is basically more than 50% if we take the sum total of Q1, Q2, and Q3. So my question is, what shall prevent you from achieving that trend this time, sir?
I didn't understand. What do you say? Quarter four, 50%? I didn't understand. What do you say?
I was saying quarter four is basically seasonally good quarter for you historically. So kind of more than 50% in the terms of revenue if we take the cumulative total of Q1, Q2, and Q3. So my question is basically what shall prevent you from achieving that trend this time, sir?
No, it's not a question of prevention. We have also given guidance of for yearly guidance we have provided. What I can tell you is, instead of getting the specific numbers, I can say that we will exceed guidance fairly well this time. Considering the first 3 quarters have been robust, on a year end, I think we should exceed our guidance. Whatever we given last time, I think we'll exceed guidance this time. So this is as per our budgets internally calculated. So I think we'll outperform whatever we told in the market earlier.
Means you have told for 40% that you have already achieved, I think. So that's why I was asking.
No, I didn't understand. What is that?
I was saying you have already achieved your 40% guidance in terms of revenue growth, as far as I look.
That is what I'm saying. So we'll exceed guidance now. That's what I'm saying.
No, we will exceed the mark.
The revenue guidance
for the full year.
Full year revenue guidance is more than what we've done already. So we've given a revenue guidance of 25-30% on a year-on-year turnover revenue. I think we'll exceed that guidance, considering the production which you're doing now and what is planned for this quarter.
Oh, okay. So that's all from my side, sir, and all the best, sir.
Thank you.
Thank you.
Thank you. We have our next question from the line of Prabir from Ratnabali. Please go ahead.
Hello, am I audible, sir?
Yes.
You're getting an echo. Please use your handset.
Sir, thank you for providing me this opportunity. I have a couple of questions. First is, if I see your quarter-on-quarter performance for the last couple of quarters, you are growing very significantly in terms of top line. My question is like, in your presentation, you have mentioned around 40,000 odd crores of opportunity by 2030. So in that opportunity, what is your expectation that you will be able to get in terms of order inflow?
No, I'm not very clear with the question. You are saying we have significantly grown top line in the last quarter to quarter, but the question is
actually my question is, so you have mentioned in your presentation that total addressable market is around $4.65 billion dollars. So by 2030. So how much are you expecting out of that total addressable market?
See, what happens is the market size is very, very large. We are addressing market through DRDO, a little bit through MOD now. Just started MOD tenders have just started coming in line, and we are trying to address the market. We need to have products to address and increase the TAM, which is why we are saying take in investments and build strategic products for future. So to increase this 2030, which we are talking about, taking a slightly medium and long-term view, we want to put infrastructure and product development to address that market. That is exactly what we're doing in areas where we have a substantial investment in competencies. So that is what we are trying to do on strategic markets and increase the size. But it's very difficult to give a particular number, as 2,000 or 3,000 or 5,000 crores. The idea is to grow to that size of company in terms of annual revenue. So we need to address that revenue, how to build that revenue, how do I convert opportunities into orders. This is what we are discussing internally. And our investment model is towards building strategic products which will allow us to convert these so-called opportunities into contracts. So that's what we're working internally. And a lot of work is going on in building strategic products here. But numbers itself, it's slightly a bit too early for us to actually address numbers. But we will be growing in the next 2 years. We have visibility, so we'll talk next 2 years, visibility of 25-30% growth is possible. Beyond that, some contracts we're going to participate, it has to happen. But what we're going to do is, in the next 2 years, to build a product base which will help us scale substantially in the coming 3 to 5 years. We need to substantially scale the business. That's what we want to do, and we are trying to see how to do this.
Okay. So another question I have, like to integrate complete radar systems, one need to have a strong capability in digital as well as in microwave. So you're a strong digital player. So in terms of microwave capability, where you are standing in comparison to your peers, some of them which has been started doing activities in microwave since 1991. So where are you right now in terms of capability?
See, we took an early decision that we have to build complete equipment. So initially we were actually in testing with the Department of Space. I'm talking 25-30 years. We continue to build test equipment for them, where we do analog and digital and power and simulation, very low-level analog. We built products from there on. And we also built our own software capability. We built our own language called DP Basic way back in 1991. So we built a very strong product company from last 30 years. So as we started involving ourselves with DRDO, we started doing platform-oriented electronics from space, from air, ground, water, underwater. Then we looked at the opportunities and said, look, if microwave is not part of our system and mechanical engineering is not part of our system, we may not be able to build full systems. So we started our own microwave department way back in 2007, 2008. It's now 14 years of work. We do world-class microwave systems in-house now. RF microwave fully we design in-house. Up to 40 gigahertz from 1 megahertz, we do everything. This can be continuous wave CW, this can be pulse, this can be narrowband, this can be wideband, this can be power. We can do anything. So we have a very large engineering call to build microwave. So we also build our own algorithms, our own domain algorithms. We do ASIC programming, VHDL, everything in-house we design. So that's the idea. We very consciously built up this capability so that today we don't have to buy and integrate. So we can do everything in-house. For example, in the digital domain, if you say the Xeon E, whatever your laptops and all coming, we build the processor boards ourselves. We don't import the boards. We actually don't import any hardware. All of them is done in-house, including microwave. So we build all of them in-house today. The idea is to try to build excellent competencies to build world-class products. That is what we'd like to do, and we've invested quite a lot in building these capabilities.
Okay, sir, you already have been selected as a development partner for Dornier airborne radars. And as we know, like in LCA also there are requirement of indigenous airborne radars, and the market size is quite large for Sukhoi upgradation as well. So going forward, is there any scope for you in this domain, as you already one of the airborne development partner for airborne radars?
We would like to work on those programs. It is up to DRDO to select us. We have the full competency to build those products which you mentioned. But customers has to select us. If he selects us, we'll be very happy to build the products. We believe we can build world-class products in those areas.
Okay. Thank you from my side.
Thank you.
Thank you. We have our next question from the line of Mahesh Bendre from LIC Mutual Fund. Please go ahead.
Hi, sir. Thank you so much for the opportunity. Sir, in 2016, 17, 19, our margins were anywhere between 16 to 20%. But last 2-3 years, we have been hitting 40% plus. So what could be the reason why we make this kind of margins?
See, our actual margins in terms of gross margin has always been 60%. But in the years we mentioned, we had two companies, Indus Texide and Data Patterns. And there was some intercompany turnover, which is not captured. So you see the margins are lower. Actual margins have never been less than that all through years in the last 30 years. Now these are integrated as a single company, and that is how it is. And second point we need to look at is, it's just not gross margins. you have to see the gross margins have been consistent all along, but it is not visible in two balance sheets, so you will not be able to make out. Now it's integrated balance sheet, you see a gross margin is different. Second point is on the EBITDA itself. What we were actually doing product development all through years, and the companies are run on cash model. Margins are always there, but the margins were used to product development, which you will write off as revenue expenses. We are continuously writing it off as revenue expenses because we were developing products and which was not costed to customer. While they were importing these products, we competed against imported systems. So when we develop the products, we absorb the development cost and expect that it can be recovered over many such programs. So that we've been doing consciously for the last 20 years. So we write off everything as revenue expenses. So what happens is in turnover, as long as we break even in revenue expenses, it's fine. That is how the business model was. And that is what you see today when the turnover goes up from 80-90 crores to 100 crores to suddenly it comes to 400-500 crores or 300 crores. There is no proportional increase in overheads in terms of manpower cost and infrastructure cost. It's not proportional. And the gross margin always has been there. So that is why you're seeing the EBITDA margin going up today. That's what you're seeing. If you take the comparison, but we should look at it slightly differently because there was some intercompany billing and all that, which is not visible now. And so going ahead, the margins have always been there. The EBITDA will be going up today because revenue is going up substantially with respect to costs in terms of operation costs. So that is why the EBITDA is going up.
So in terms of a top line, do we show only the value addition part that we do for customers, or we also add raw material prices into that?
No, whatever we buy, we add the raw materials. This is gross margin. When I say it is sale revenue less raw material cost. That's what I mean by gross margin here. And the EBITDA, of course, includes not only raw materials but also operating overhead expenses, and manpower costs and other costs. You know that. So, of course, it's not just a value add. It's not build. It's a product we build.
Sure. And sir, you talk about going into new businesses. You are raising money for entering into building a capacity for newer businesses. Will you be able to maintain these kind of margins in that business also that we are planning?
It should be. We would like to have the same margins. But what happens is when you get that margin, the size of business is 2,000 crore, 3,000 crore, 1,000 crore each tender. The size of business is higher. They may also have integration into issues. So we have to buy and integrate. That also we need to look at. And it is going to be a competitive landscape. People import and integrate and do this. So we need to look at the competitive landscape and then price it accordingly. What gives us the confidence that we do this in India? I have flexible costs. Instead, not flexible costs, I said the selling price can be flexible based on competitive numbers because we work with raw material costs. So IP is generated locally. That gives us a strong foothold to be competitive in the market. The size of market being large, I think we should do this earlier than later, is what we believe.
Sure. Thank you. Thank you so much, sir.
Thank you.
Thank you. Ladies and gentlemen, due to time constraints, we request you to restrict to 2 questions so that the management can answer queries from all participants. We'll take the next question from the line of Abhishek Singhal from Naredi Investment. Please go ahead.
Good afternoon, sir. Thank you so much. So my first question, as per current order book and considering expansion, so in how many months you will complete this order?
I couldn't hear you. Your voice is breaking. I'll repeat the question. The current order for when will I finish the order? Is that the question?
Sir, as per current order book and considering expansion, so in how many months you will complete this order?
Which order?
Sir, 888 rupees crore order.
Okay. I think most of them have to be executed. About 90% of them has to be executed in the next 2 years.
Okay. And sir, second question, how much amount to spend on R&D expense in Q3 and what is the strategy for R&D expense?
See, as a normal practice, we develop products against contracts. And so we write it off with revenue expenses as the contract gets executed. So we don't classify it separately as R&D and capitalize it. We've not done that till now. We do a lot of products, examples of products. Sometimes people import it but we build the product here. So we spend a lot more money in developing the product, but it's written off as revenue expenses. We're not capitalizing it at the present moment. We need to, because these are all against contracts we design, or expecting contracts we design, and then get the contract, we expense it out as per contract. We don't carry it in our balance sheet as an additional asset. So I thought this is prudent. That's why we were doing it. So, but we will spend as we go along. That is why we are trying to take some money and seeing how do we want to do this. So this is in discussion with our board. We want to take some very strategic positions today and scale the business substantively. So we need to scale. The opportunities are now. So we want to take our competency model and scale that business and position ourselves very differently in the next 3 to 5 years. That's what we'd like to do. But yes, then that will involve a fair amount of development. But we've been very, very cost effective in our development because we build building blocks so that the reuse of the products across various platforms is possible, various even radars or various other, even across programs and verticals, we can use the same products. So that is how we design, so that we are consciously seeing that the money is well spent and the risks are reduced. So we'll continue to do that and take aggressive positions in realizing big contracts. So we plan to do that.
Okay, thank you so much, sir.
Thank you. We have Anik from the line of Jatin Jadhav from Surstar Capital. Please go ahead.
Hello. First of all, congratulations
Sorry,
on
sir,
the
you're not audible. Can you use the handset, please?
Hello, am I audible now?
Yes.
First of all, congratulations to the management for an amazing set of numbers. My basic question is, since Data Patterns provides subsystem radar subsystems currently, and you'll be moving forward to the entire system. And in your product suite, there's this is just an example. There's a product called R5. It's a receiver and exciter central unit. And there are other competitors as well who produce the same exciter and receiver unit. So I want to understand what is the difference here. Is it your exciter unit, this functions for a different band of radars which are used? How is it differentiated?
I missed you in between. Your voice is breaking. Are you saying that you're seeing that we build exciter receiver units, and you also find that the same exciter receiver units is also part of competitive landscape? So yes, how are we differentiated? Is it in frequency bands, or what is the difference? Is that the question?
Yes, correct.
Okay. See, a radar, I'm going to technical. We'll get a technical question. A radar consists of the antenna. This can be traditional or a phased array antenna. Then the receiver exciter unit is the portion which can digitize or up convert, give me waveforms. Then the up down converters are there. Then the signal processing units are there, and then the mechanical system, display and consoles, and this is the software. When we put this, we say in Data Patterns we build everything. We build the antenna, we design the antenna, we design the mechanicals, we design the waveforms, we design the down converter, up converter for all bands. We talked about bands, RF bands. From VHF, we have orders. We have very large phased array radars installed in Cochin 7 years back. A full radar with 350 kilowatts of power is a phased array where everything is designed by us, including software, implementation, everything. So we do end to end. Now, if you say compare with competition, they may be doing exciter receiver, they may be doing a signal processor, but what happens is the combined capability what we have is at the present moment we believe is better than what is available in competition. Of course, this may change in the coming years. So what we are trying to do is build a domain and build the radar ourselves. For example, precision approach radar. Full development was done after the inquiry. So we designed this entire system was done, and we were fortunate to get a contract for 300 plus crores, which is under execution. Similarly, we would like to look at such contracts and see how we want to build positions. Instead of tying up with somebody, can we build our own systems here? And with DRDO, we do a lot of radar subsystems. The exciter unit as a subsystem we have done for them. We also do the antenna as a subsystem for them, the signal processor as a subsystem for them, the power systems as a subsystem for them. But as a radar as a whole, almost all the subsystems we have delivered. So, we built the competency, now we want to build the domain and the end system.
Okay, got it. Then, hello, am I audible? Yeah. Just I want, and then another question is just, can you give me a guidance for this year, any numbers, the margins and the revenue growth?
This year means FY23 or FY24?
FY24.
Yeah, we told you, we'll do this 25-30% scaling we can do coming year also.
All right. And the margins will be sustained as you mentioned earlier, right?
Similar, around 30, around 40%.
Yeah, in the similar range.
We should be able to do is what I think as of now. Right. We have not gone into FY24 as of now. We are still trying to close FY23. The focus is here.
Got it. No problem. All right. Thank you so much, sir. Have a nice day.
Thank you. We have our next question from the line of Akash Bachawat from NAL Securities. Please go ahead.
Am I audible?
No, sir.
Yeah.
We cannot hear you. The volume is very low.
Yeah, am I audible?
But
Hello.
there's an echo coming from your line, sir. Can you use your handset, please?
Okay, I'm using my handset. Just hold on. Yeah, is it okay right now?
Yes, please go ahead.
Yeah. So I just have, firstly, congratulations on a great execution, and I just have a few questions regarding understanding of the business. We see our business is quite working capital intensive, and because of the nature of the business and the product, our inventories cannot be reduced. But if I see the prior years and all, you have used quite a few amount of debt, and even the last year you have used IPO funds to fund the working capital. So is this the enabling resolution also to fund the working capital requirements of the firm? And if yes, our counterparties are generally government entities and PSUs. So why aren't we using discounting mechanism of receivables? Like our receivables are high, we can discount through banks and reduce our receivables. So why aren't we employing that? So if you can answer that.
There are two things I'd like to explain.
Yeah.
Working capital intensive. Okay, that's the statement is made. See, our company, the business model is slightly different from what everybody thinks. That we are saying conversion cycle days is 300 days, 350 days may be right. But when you say working capital intensive, we take mostly non-fund limits from bank. Okay, so if you take our fund limit, for example, as a present time, we probably have only used 2 crores to 3 crores out of 300 crores of non-fund. So our contracts also comes with advance, stage payment to part delivery, and the final payment based on installation acceptance. Now, so actually speaking, we can even manage the working capital without a lot of fund based. We can manage it out of advances which takes out of banks, so out of our customers. That is how we've been managing it. So that is how it is presently also. But yes, we need to bring the cash collection days and the inventory days. We need to bring that down. The inventory days is slightly going up because today we want to bring it down this year, but we want to going up because of unavailability of components or not even visibility of when the components will come. So we gave a priority to say we need to execute contracts, and so we said we'll buy ahead of time and store. So that is being done, and as you go along coming year, it will start going down because this practice is the last 1 year. Now slowly the inventory position, availability position is more predictable. So we will probably not follow that as we go along. Once we get a bit more comfortable on getting components when you need them. That is one. Point number 2 is the debtor days. So here what happening is, yes, we can do discounting, but we will not necessarily do discounting because we are getting collections, we are cash positive. Problem here happens is in some of the development contracts, the acceptance test, though it is done as per contract in our office, when they integrate the system, they take a lot of time to do system integration as a radar, as electronic warfare, flight test, and they typically tend to keep the money with them for a long time without clearing it. That is why the debtor days becomes higher. But we don't have any bad debts. We get 0 bad debts and all these.
Yeah. So exactly, because your counterparties are so good, government entities and PSUs. So you can't because I see.
The product has to work, otherwise this problem will happen.
Okay, that's
the products work, and this is maintained for the last 20 years as operation without a problem. So we don't generally have a problem, and as we go along, we need to bring it. The more production orders start coming in, the lesser the data cycles. The remix has to happen. But now we are just going to MOD tenders. We're getting into another area of uncertainty. We're learning this. This is a journey which has to be learned properly. Once we learn it, we know how to play the game. So, but we are comfortable now with that. It will be brought down. The working capital days will be brought down as going along. I don't have an issue on funding this at the present moment. We don't expect funding problems as we go along. And this whatever we are raising fund is going to be only for a little bit portion goes to working capital. It is more to build strategic products for growth, not to address purely working capital. It may be a capex, it may be some test equipment, some infra, because these are necessary to scale growth. The growth is happening in the next 5 years. This is the time when we have to have products to position ourselves rather than react to inquiries. We can't react to inquiries any longer. Those days are gone. The timelines we had to react to inquiries those days do not exist now. Government is now saying, I want emergency procurement. They'll buy and you will deliver in 12 months. They want demonstration in 15 days. We can't do this unless we have a product portfolio which can position ourselves. Otherwise, we lose the business. We found the last 3 to 4 months' time, a flurry of emergency procurement has happened. All products which we could have given some time demonstrated, but since the lack of time, we could not even participate. We are saying, no, this is not good enough. We need to say, address markets as it evolves, and this is not a one-off case. It's going to be the order of day. And it's all number of them going to come to make 2, where we need to actually position the products and see that demonstration. If we do this early, we become early birds, then the contracts happen earlier. So looking at how the market has completely metamorphosed and changed, they said, we told the board that we need to take some urgent action and see that we position ourselves, and we need to scale the business to many thousand crores a year. If you want to do that, we need to position ourselves differently, and the opportunities are there. And we have the strength and the capability built over many years. We want to back on our capabilities and go to market. This is what we want to do. The fund is exactly not for.
So there's one additional question.
We're a debt-free company now.
One additional question in it. So will you be, it's an enabling resolution, so will you be picking up funds in tranches or at a go at 500 crores?
These are things which we need to be worked out. We'll go to our bankers, with the lawyers, discuss internally. It's a bit too early to answer this question, but we will do this in a few weeks now.
Okay, sir. And my second question, sir. My second question is regarding, if I see historically, your Q4 has been 50-55% of your revenues. So is the Q3 execution a reclassification of better execution? So therefore Q4 will be a lesser percentage of revenue as a whole year, or your Q4 will still remain 50-55% of your revenues?
See, all of us would like to, our business, today we are seeing 55-60%. For 4 years back, it was 90%, 85% Q4. So ours was a year-end business all along. Now we are able to taper that year-end to a quarterly sale, which is what the market wants, which is what you want. And we want to do this because cash flows becomes good, and then, so we all want to do that. With the luxury of an order book and more production orders, we are able to then position ourselves properly and utilize infrastructure on a normalized basis, which is what all of us like to do. We are going towards that. But having said that, our guidance, what we gave, we will exceed our guidance on the overall revenue this year. Since we have done well in the last first 3 quarters, we expect that beginning of the year we gave a guidance of 25-30% growth. I think on revenue, I think we will much exceed the guidance given. I don't want to get into exact specific, but we will exceed guidance as we always do.
Okay, thank you, sir. Thank you so much.
Thank you. Due to time constraint, that was the last question. I now hand over the call to the management team for closing comments. Over to you, sir.
Yeah. See, what I want to tell is that our internal estimates, we are exceeding on execution today. We have recruited, scaled our company by 700-800 people to now more than 1,000 odd people. We are also expect to get 100 more people in the coming 2-3 months. We will be building more competency top-down, every area of organizations to build up a people base and employee capability to address markets is happening. So that is going to be a key internal decision taken. So we'll build capability, substantial capability as we go along. Second key decision we've taken is to build infrastructure to address growth which is happening. Everybody knows that Indian market is opening up for defense to Indian vendors today. It is a substantive opportunity. It is not a small opportunity, it's a substantive opportunity. The problem here is that since we never built full products in India, it has always been government driven all through. it is taken a number of, it's going to be difficult for suddenly somebody to come out of the industry and says, hey, I have a product here. I'll then, whatever everybody wants, I'll give the product. It doesn't happen like this. So it takes a lot of time to build the product, validate it, take it to market, especially in a different scenario, especially because it's a multidisciplinary product. So what people are doing is tying up with foreigners, making the work share arrangement and offering the product to the market, to the MOD. And now that they have last 5-6 years opened this and gradually making it more and more tougher to direct imports. So this is happening. More make one, make twos are coming in, which they allow even development to happen during contract enabling stage. So the direction is very clear. Government is very, very clear that this is not going to, this is not business as usual, import and integrate. They have to do this in India and build an industry. They've said so much on this. I think based on the capability we have built, we're going to back ourselves up and address these opportunities and build an equipment supplier in India, which is not what it is the case today. So we want to differentiate ourselves, build the competency, build products, address market, and go for substantial scaling. This is what I like to do. This is a dream which I want to play. I hope it works out. But we are on the right track. The direction is very clear. We have a board which fully supports us, and so we're going to give it a best go. So thank you for calling and listening in. Thank you very much.
Thank you very much.
Thank you.
On behalf of Go India Advisors, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
The conference is no longer being recorded.